So the third video in our structured product series is going to be around booster notes. Now these are a little bit more complicated than the auto-callable notes or marathon notes, but we're going to review some of the important details and illustrate just when these investments should be actually considered within a portfolio. Similar to other structured products, they enhance return, but they do it a little bit differently. They provide a significant boost, just like their name suggests, to returns that are otherwise would be slightly positive. And as with the other notes, they are inefficient and they have increased price volatility prior to their maturity dates. And again, these do not pay dividends to investors throughout the term. So now let's take a look at the actual characteristics and what this boost actually consists of with an exact example. So as you can see from the illustration, what it's going to show is the actual boost, which is that green line. That's the actual potential return at the end of the 5-year term from the actual return that has been achieved. So you can see there's a substantial difference. As with the previous structured products, there is also a maturity barrier that can be applied. And with that maturity barrier, similar to previous structures, it will provide a return of 100% of your capital if the note matures above that maturity barrier but still in negative territory. And similar again, consequently, if it matures below the actual maturity barrier, you are stuck with the 1-to-1 downside, and which is the same risk that you would have on the underlying security. So we just received some very special pricing on the 5 Canadian banks at the time that this video is being shot, in which it provides an immense boost from the underlying return. And we're gonna go through those exact figures to show you the benefits of this type of note. So what this note would actually provide is a 102.25% boost if the 5 underlying banks are positive by even $1 after a 5-year term, which is huge advantage. Let's say that the Canadian banks provide a 70% return from this value. It would be boosted up to 102.25%. And that can go all the way down to, like we said, the first dollar of positive return. So if in 5 years it matures with just a 1% return, it will be boosted up to the 102.25% mark. And then once again, with this structure, if it matures below positive but above the maturity barrier, you get 100% of your principal back. And then once again, 1-to-1 downside below that maturity barrier. So as you can see, these booster notes are very special, and although a little bit complicated, what they are great for is flat to slightly positive markets or underlying securities over a prescribed period. So for instance, what you're betting on with a booster note in comparison to a marathon note is that the return has a high likelihood of being positive within the term, but not necessarily a tremendous return. Because what you would rather do then is have a multiplier similar to the marathon note where you can maximize upside. Whereas with booster notes, as you can see, even a slightly positive return, you can have that immense boost to get you still a very competitive return, even in a flat to slightly positive market. Next, we're going to talk about contingent income notes and how those are really important for very conservative investors that want to have consistent income.